Hello everyone, welcome to Tesla Daily News. Today is June 4th, Thursday, and the following is the latest Tesla news. According to market data, Tesla stock opened at $418.70, traded between a low of $416 and a high of $433.60, and closed at $423.70 on volume of about 44 million shares, essentially flat versus the previous close. Short technical take, uptrend intact. Intraday volatility shows active dip buying. For investors, the key takeaway is that the stock held near recent highs despite heavy trading, suggesting that buyers are still willing to support current valuations even as macro and company-specific headlines remain mixed. According to 7 News Australia, Tesla has just achieved a historic milestone in one of the world's more competitive developed markets. In May 2026, the Tesla Model Y became Australia's best-selling vehicle overall for the first time, and the first electric vehicle ever to top the country's monthly sales chart. Australian new vehicle deliveries in May were slightly down overall year-on-year, but battery electric vehicles more than doubled, with EVs reaching almost a fifth of the entire market and electrified powertrains of all types approaching half of all sales. 7 News mentions that Tesla, with only the Model 3 and Model Y on sale in Australia, climbed to 6th place among all automotive brands in the country, tying its previous best ranking. The Model Y midsize SUV dominated the medium SUV under $65,000 segment with more than 5,500 units delivered, clearly ahead of the Toyota RAV4 and Hyundai Tucson. This makes Australia yet another major right-hand drive market where the Model Y is not just a leading electric vehicle, but a leading vehicle, period. From an investor's perspective, this Australian data reinforces a few themes. First, EV adoption is moving past early adopters and into the mainstream in key markets, even as total vehicle sales soften. Second, Tesla is still able to command segment-leading volumes without a wide model lineup, pointing to brand strength and the scalability of its platform approach. Third, strong Model Y performance helps support margins because it is a higher-priced vehicle relative to many compact cars and small SUVs, which can be beneficial to Tesla's overall profit mix. According to the Electric Vehicle Council and the FCI, quoted by 7 News, electrified vehicles in aggregate made up nearly half of new vehicle deliveries in Australia when you combine battery electric, plug-in hybrid, and conventional hybrid powertrains. While Tesla's share of total EV volume in Australia is gradually facing more competition from Chinese and legacy brands, being at the very top of the entire market indicates that Tesla still sets the benchmark many competitors are chasing. According to Ekstra Bladet in Denmark, there are growing business ties between Elon Musk's companies that could matter for Tesla's long-term strategy. The report, based on disclosures cited by financial outlet Barron, says that SpaceX has become the single largest customer for Tesla's Cybertruck. SpaceX is reported to have purchased around 1,600 Cybertrucks, with an order value of about $131 million, and the article notes that these purchases were apparently made without any obvious discount. Ekstra Bladet notes that these 1,600 units would represent roughly 8% of all Cybertrucks sold in the United States, at a time when total Cybertruck sales have fallen sharply from their initial ramp. This internal demand from SpaceX, while not a game-changing revenue source by itself, helps support the early production run and keeps the vehicle visible in a fleet context, particularly around launch facilities and other high-profile SpaceX operations. For investors, this relationship underscores a broader pattern. Musk-controlled companies frequently transact with each other, whether through vehicle purchases, shared projects, or equity ownership. The article points out that Tesla owns a significant stake in SpaceX, obtained through the integration of Musk's AI company xAI into SpaceX, and that several SpaceX board members have prior Tesla connections. It also highlights collaboration between Tesla and SpaceX on a digital AI assistant designed to tap the combined computing power of parked Teslas. From a stock perspective, these cross-company ties cut both ways. On the positive side, they may accelerate innovation by aligning road-based artificial intelligence, robotics, and space-based data infrastructure. That could help Tesla leverage capabilities from Starlink, orbital data centers, or shared semiconductor development more quickly than standalone automakers. On the risk side, significant related party transactions and overlapping governance can raise corporate governance questions for institutional investors who prefer cleaner separation between entities. According to the Motley Fool, speculation is growing that Tesla and SpaceX could ultimately merge, especially with the highly anticipated SpaceX initial public offering expected in June. The article notes that CNBC has reported Musk has internally floated the idea of combining Tesla and SpaceX, and that prediction markets currently assign roughly even odds that some form of announced merger could surface within a year. The full article emphasizes three main arguments that might support a merger scenario. First, Musk's control over both companies, through large voting stakes and leadership positions, means that if he decides a merger is strategically important, there are few practical obstacles from a control standpoint. Second, the operational overlap between Tesla and SpaceX is increasing. SpaceX wants to build orbital computing networks and data centers for artificial intelligence, in addition to running Starlink's global connectivity. Tesla, meanwhile, needs robust connectivity and cloud-based compute for full self-driving, robotaxis, and humanoid robots such as Optimus. Starlink and orbital infrastructure could provide the backbone for a globally connected Tesla AI ecosystem. Third, the article points to funding. Tesla currently holds around $45 billion in cash and has historically generated positive free cash flow from its automotive segment, even if recent years have been more volatile. SpaceX, by contrast, is described as burning billions of dollars per quarter as it develops Starship and invests heavily in AI-related data centers and Starlink expansion. Even with plans to raise around $75 billion through the IPO, the company could eventually face funding constraints if its capital-intensive projects ramp faster than revenues. From an equity holder standpoint, a merger of Tesla and SpaceX would effectively combine a profitable, though cyclical, EV and energy business with a highly capital-intensive space and communications venture. That could diversify revenue streams but might also dilute near-term automotive margins as cash is funneled into rockets, satellites, and orbital compute. It would also give public Tesla shareholders direct exposure to Starship, Starlink, and space-based AI infrastructure without having to wait for separate listings. However, the article also stresses that these ideas remain speculative. Many of the envisioned AI and space projects are still on the drawing board or in early testing, and engineering, execution, and regulatory challenges are significant. Investors should treat merger talk as a possible long-term scenario rather than a base case until there is formal communication from the companies or regulators. In the meantime, the increasing operational overlap and joint semiconductor plans with partners such as Intel are important strategic signals of where Musk wants the combined technology stack to go. According to a detailed report from Reuters, summarized in Taiwan's Liberty Times Auto channel, Tesla's full self-driving system is once again under scrutiny, this time from former insiders. Reuters interviewed 9 former data labelers and a former autopilot engineer who worked on Tesla's self-driving technology. These specialists reviewed real-world driving footage and annotated it so that Tesla's AI systems could learn from correct and incorrect maneuvers. The former employees said that, despite years of development, the FSD system still struggles with certain basic but safety-critical driving scenarios. These include correctly yielding to ambulances, stopping for school buses, interpreting complex construction zones, and reliably taking freeway exits. Some interviewees described instances in which the system failed to recognize animals on the road in time, hitting cats, dogs, and deer, and coming uncomfortably close to pedestrians, construction workers, and motorcyclists. One former worker recalled cases where FSD did not detect a highway exit correctly and headed toward a barrier, or drove into closed sections inside work zones. Liberty Times reports that some of these former staff believe Tesla has heavily trained FSD on specific locations and scenarios to perform impressively in curated demonstrations, but that the system may lack the generalized robustness needed for wide deployment as a truly autonomous solution. When asked whether they would personally ride in a Tesla using FSD or a future robotaxi service, several interviewees expressed strong reservations. One is quoted as saying people should not blindly trust Elon Musk's statements, and another stated they would not ride even if they were paid. The Reuters investigation also compared Tesla's safety claims to federal crash data in the United States and engaged 11 traffic safety researchers to review the findings. The report concludes that Tesla's public presentations of FSD safety look more like aggressive marketing than rigorous scientific analysis. For example, company executives have claimed FSD is roughly 10 times safer than a human driver. Critics argue that Tesla benchmarks its crash rates against the broad U.S. vehicle fleet, where the average vehicle age is around a dozen years, while Tesla's cars tend to be newer, more technologically advanced, and often driven by more affluent, tech-savvy owners. That makes direct comparisons difficult. For Tesla investors and enthusiasts, this story is highly relevant. On the one hand, autonomy and FSD are central to many bullish valuation models that assume future high-margin software revenue and a robotaxi network. On the other hand, insider accounts of safety shortcomings and disputed safety statistics raise regulatory and reputational risks. If regulators tighten oversight or demand more conservative rollouts, that could slow revenue from FSD subscriptions and hardware, and delay any robotaxi business. It also increases the importance of transparent data and independent safety validation to maintain consumer trust. According to the Times of India, Tesla and SpaceX are once again at the center of a high-profile legal development involving Elon Musk's AI company XAI and the social platform X, in an ongoing antitrust and competition lawsuit that X and XAI have filed against Apple and OpenAI. The U.S. federal judge has ordered Musk's side to produce business emails from Tesla and SpaceX accounts as part of the discovery process. The court order, issued by U.S. District Judge Mark Pittman, affirms a previous decision by a magistrate judge that communications from Musk's Tesla and SpaceX email accounts, as well as certain text messages and XChat communications, must be disclosed if they relate to X or XAI business. The judge noted evidence that XAI's chief financial officer had sent financial updates to Musk's SpaceX email address and that Musk had invited an Apple executive to reach him at his Tesla and SpaceX emails to discuss matters related to X, XAI, elections, advertising, and AI strategy. From a legal standpoint, the judge reasoned that because Musk owns and runs X, XAI, Tesla, and SpaceX, he effectively controls relevant records at all four entities. As a result, X and XAI cannot shield potentially relevant communications simply because they sit in mailboxes labeled with other company names. The ruling also cites a prior case where Musk was required to produce similar materials, reinforcing the view that a CEO who uses non-company emails for company business still has to produce those messages in litigation. For Tesla shareholders, this order is important for a couple of reasons. First, it reinforces that Musk's use of multiple corporate platforms for overlapping ventures can expose Tesla and SpaceX records to discovery in cases where they are not direct parties. That can raise privacy, compliance, and reputational questions, especially if internal strategy discussions or sensitive negotiations become public through court filings. Second, the case highlights how deeply intertwined Musk's ventures are. Strategies around AI, app distribution, and competition with Apple and OpenAI may involve resources, plans, or communications that cross corporate boundaries, blurring lines between Tesla's core automotive and energy business and Musk's broader AI and media ambitions. While this particular lawsuit is not directly about Tesla's products or financials, extended legal battles can consume management attention and may create headline risk. Investors may also watch whether regulators, boards, or major shareholders push for clearer internal policies on how Musk uses email, messaging, and cross-company resources when negotiating or litigating AI and platform issues. According to the Australian Financial Review, Tesla chair Robin Denholm has delivered a pointed message to Australian startup founders and the broader technology ecosystem that also sheds light on how Tesla's leadership views the AI opportunity. Speaking publicly after changes to Australian capital gains tax rules caused concern among local founders and investors, Denholm urged entrepreneurs to focus less on complaining about policy shifts and more on building globally competitive companies for the AI age. The AFR notes that Denholm criticized what she sees as a lack of ambition among some Australian investors and firms, arguing that the real challenge is to compete at global scale in artificial intelligence, not just to secure favorable domestic tax settings. Coming from the chair of Tesla, this stance is a reminder that Tesla's board and leadership see AI not only as an internal technology for autonomy and robotics, but as a major global economic shift that will reward companies able to execute at scale, move quickly, and think beyond local markets. For Tesla followers, Denholm's comments help frame how the company's governance views risk and opportunity. On one side, there is clearly an appetite for bold AI bets, whether in self-driving, humanoid robots, or collaboration with other Musk ventures. On the other side, the message that entrepreneurs should act rather than complain suggests that Tesla is likely to keep pushing aggressive development and deployment, even when regulatory, tax, or political environments become more uncertain. Collectively, today's stories paint a picture of Tesla at a crossroads. On the product side, the Model Y is reaching historic mass market leadership in places like Australia, underscoring the strength of the core EV franchise even as competition rises. On the technology side, FSD continues to draw both optimism and serious criticism, highlighting the gap between Musk's long-term autonomy vision and the current real-world performance described by some insiders. At the same time, corporate and strategic developments from SpaceX's large Cybertruck purchase and the talk of deeper Tesla SpaceX integration, to legal rulings about Musk's communications and public comments from Tesla's chair on global AI ambition are reshaping how investors should think about Tesla. The company is no longer just an automaker. It is embedded in a wider constellation of AI, space, and data-centric ventures that could either amplify value or complicate governance, depending on execution. That's all for today's episode of Tesla Daily News. Thank you for listening, and if you find this content useful, please subscribe and share it with fellow Tesla watchers and investors.